Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, August 2nd, 2024. 3 days ago, the Federal Open Market Committee decided to leave its policy rate unchanged at 5.25% to 5.5%. The press release, which I'm showing you here, explaining that decision noted, the committee does not expect it will be appropriate to reduce the target rate until it has gained greater confidence that inflation is moving sustainably towards 2%. And I'll just highlight that for you here somewhere. Here it is. All right, here in the third paragraph. However, after seeing today's jobs report for July, the FOMC may want to reconsider that decision. Last month, the national unemployment raised to 4.3%, and that's the highest it has been since October 2021. At the same time, the economy added 114,000 net new jobs last month, far below the $175,000 figure expected on Wall Street. So today's jobs report did come as a shock. Here's the press release. I'll have a link to it here, and you can go in and read it yourself. But nevertheless, those were numbers that really nobody really had on the radar. So the reaction in the financial markets was swift and severe. Less than an hour after opening, all the major stock market indexes were down by 2% or more. So here's the S&P 500. I'll show you year to date. And just think, just a little over 2 weeks ago, on July 16th, the S&P 500 index hit a new all-time high. And since then, it's declined by about 4%. And if you look at the chart here and way over here on the right where we are today, that comes all the way back to June. So basically, giving up about 2 months worth of gains. Now, the bond market's response was even more pronounced. The yield on the 10-year Treasury note fell below 3.8% today, the lowest it has been in over a year. So here's the 2-year chart of the 10-year Treasury note, and you can see we got to come all the way over here to just a little over a year ago to when it fell below that. So make no mistake about it, just about everybody now is expecting a rate cut from the FOMC when it meets next in mid-September. But by then, it may be too late. If the jobs market is deteriorating faster than expected, then consumers will slow down spending. And since consumer spending is what has been propping up the economy while the FOMC was raising rates over the past 2 years, there is now a fear that the economy may be contracting. For that reason, I suspect that the FOMC will be buying bonds in the open market to help push down interest rates. That would contradict the statement it made a few days ago when it said, in addition, the committee will continue reducing its holdings of Treasury securities and agency debt in agency mortgage-backed securities. However, that assertion was made before we saw today's jobs report. With the latest inflation figures coming in better than expected, the FOMC must now prioritize its other mandate to encourage maximum sustainable employment. And to do that, interest rates must come down so consumers keep spending and employers keep hiring, or at least don't lay people off. At the moment, Wall Street isn't taking any chances. Today, the CBOE Volatility Index, or Fear Index, soared to its highest level since March of last year. Now remember, high means more fear, lower means less fear. So here's a 2-year chart of the VIX, and you can see, when I put it on here, you got to go all the way back here to March of last year. Now you may recall that's when the Silicon Valley Bank failure triggered a brief wave of panic that quickly subsided once it became apparent that the rest of the banking sector was on solid footing. I believe something similar will happen this time. The cap-weighted indexes were overvalued to begin with, so some reversion to the mean was inevitable. The next 6 weeks may be bumpy, but by the time the FOMC issues its next policy statement on September 18th, the financial market should be back on solid footing. And that's this week's PF video update, and I look forward to talking to you in another week. Thank you.